Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. Today is a battle, an age-old battle between good and evil. No, not really. It's between property and shares. Which one is good? Which one is evil? Which one is the best? Which one must you be investing in? I think you're going to be surprised about how we tackle this subject. It's not going to be the slam dunk that you think it is.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a company that invests more than £100 million worth in property every year on behalf of our clients. You can find out about that at propertyhub.net/invest. But not everyone is keen on property. Some people swear by shares. Are they right? Which has performed better in the past and which is going to do better if you start investing today? We have put together our own data that I've not seen anywhere else before, and it casts a very interesting light on things. So do stick around.
So it's time for our news story of the week, and this is a really interesting news story. The headline explains enough, but we'll go into more detail. And the headline is, from Zoopla, buying beats renting. First-time buyer mortgage repayments 20% lower than rent across Great Britain. Rob, that's quite a percentage. I think a lot of people just assume that property is really expensive and that renting is more efficient to do, but that's not the case.
No, and I was really surprised by this. And obviously, it's talking about averages, they made assumptions, so it's going to be different for every person. But I would have assumed that because mortgage rates have gone up so much over the last few years, that of course that means mortgage repayments are higher and therefore renting would be relatively cheaper than it had been previously. But of course, rents have gone up substantially over the last few years as well. And so I assume that is why buying, despite rates being higher, still comes out best. And I think, Rob, that the regional breakdown is really interesting as well, because in London and the southeast, it's roundabout evens. They come out pretty much the same. But then when you go to places like the northeast and Yorkshire, where house prices are obviously cheaper, therefore mortgage payments are going to be lower, there's a huge difference, renting up to 24% cheaper in the northeast, for example.
Yeah, that is really interesting. And it's for that and many more reasons why we added Newcastle as our one to watch at the beginning of the year when we picked our best areas to invest. We are looking at the northeast more and more now because it just seems undervalued. And when you see that discrepancy between pricing of rents and pricing of property appears to be very cheap. The other thing, obviously, is that yields are going to be very strong in that area as well. Now, before you go and start buying everything up in the northeast, because I know some of you are very keen, remember you need the fundamentals, and there are areas in the northeast which do not have those fundamentals. So make sure that the fundamentals are very strong in any area that you invest in. And cheap doesn't always mean great. One of our mantras we talk about a lot on the Property Podcast is don't just go into an area and buy the cheapest thing you can, buy the best quality product in that area, the best quality home, and you will tend to do well. But northeast, yeah, absolutely expect that to be there. Yorkshire second and northwest third. It's no surprise that we're very active in those two areas. And judging by this data, Rob, we should continue to keep a keen eye on the northeast.
So you are here listening to this podcast because you are interested in investing in property. But a lot of people would tell you you're wrong. A lot of people will tell you you're an idiot for investing in property because shares are easier, they're safer, and they do better. But who is right? Property versus shares? It's a debate that will never truly die, but we've been doing some digging into how each has performed in the past, and the results might surprise you. So in this episode, we're going to look at whether property or shares have done better in the past, which is likely to do better in the future, because that is not the same thing at all, and how you should ultimately decide which is right for you.
Our focus today is going to be on the financial, and I think you're going to be surprised by some of the things we're going to uncover here, but I think we need to state the obvious, because sometimes the obvious isn't stated enough. And that is that they are completely different assets. They're different in terms of effort level, as Rob's already said, liquidity, volatility, importantly as well. But we're just looking at the numbers in this episode. So you have to take into account, once we've run through the numbers, all the other things that are involved. And we have talked about them in the past. But today, I think the numbers tell a really, really interesting story. And Rob, let's go in our time machine and let's go back 25 years. And back then, as you'd expect, the world was a very different place. And let's pretend we could invest back then, a bit like Biff from Back to the Future. But not invest, he gambled. Still, anyway, we've got our data in front of us. We're 25 years in the past, and we can make a decision on what to invest in. Which one would we do based on the numbers?
Well, let's see. Property over the last 25 years has had a 5% compound annual growth rate. That is going by nationwide figures. So if you average it all out, 5% growth per year. Now you have to compare that with shares, and with shares it's difficult because there's different markets and everything else. There's different parts of the world. I think the fairest comparison to go with is a world stock index. So you're not sticking just to the UK. You're not going picking the best market in the world after the fact. You're just saying, I don't know what's going to happen. Let's buy into a world index tracker. So property, 5%. World stock index, 7.65%. So stocks on the face of it have outperformed property over the last 25 years. Now, that does include reinvested dividends for stocks and not rental income for property, because that would make the figures way too difficult. So maybe by the time you've included that, it's equal or property's getting close. But it is certainly not a slam dunk for property. Maybe it's even ended up losing. And I think that'll be surprising for a lot of people.
I'm not so sure, Rob, because a lot of people have recency bias. If people judge on the last handful of years, then people would be thinking that stocks are the stronger performer. But actually, the data shows us that it's very, very close if we go back 25 years. But let's take off our flares for a moment and put on our Victorian attire. And let's jump back in a time machine to 145 years ago. Let's stretch this out. Let's get some real data. And yes, this data does exist. So let's see how things have performed then. Well, property, again, has grown by 5.4%. And the stock market has grown by 6.8%. So a lot closer. Now, this time around, because of the sources of the data, this does include rents and it does include dividends. So the last set of data didn't include rents, but this set does. And that's probably the reason why it's a bit closer. But over the long term, the stock market has outperformed the housing market in the UK. Not by a wide margin, but enough of a margin that it would have made a real difference over time. So, Rob, whichever way we look at it, over the last few years, over the last 25 years, or the last 145 years, shares have outperformed property when you put them head to head. So join us next week for the Shares podcast, where we'll be talking about our best investment picks.
Yeah, it's pretty cut and dried, isn't it? And we haven't even mentioned that, don't know about going back 145 years, but as of right now, you can hold shares in tax-protected vehicles like ISAs and SIPs. So taxes are going to take a smaller bite out of your gross returns as well. So shares are absolutely smashing it. But thankfully, so we don't have to go and redo the artwork for this podcast, property does have something in its favour that we have missed, and which is often missed when people are talking about this subject, which is leverage. So property may come out marginally behind, but with leverage, you can buy 3 times as much of it. And on one level, that is kind of cheating, but it's also true. It's not normal to buy stocks with leverage. You can, but there are lots of reasons why it's not a good idea for most people. Whereas with property, it's extremely normal to buy property with a 75% loan. And as you'd expect, that completely changes the figures, because if you're buying 3 times as much of something with the same amount of money, you're going to end up doing better. And indeed, that is the case. So if we go back to our same example where we went back and invested 25 years ago, if you put £100,000 25 years ago into the World Stock Market Index, that today would be worth £631,000. If instead you'd use that same £100,000 to buy £300,000 worth of property with leverage, then your equity today would be worth £815,000 plus 25 years of rental profit. So you've come out £200,000 ahead plus 25 years of rent. So I think people have different views on this, because when you're putting two things head to head, using leverage on one but not on the other does totally seem like cheating on one level, but it's also reality.
It is absolutely reality. Next to nobody leverages shares, and for good reason, because you get wiped out very quick because it is more volatile, it moves a lot quicker. But it's widely accepted that you leverage with property. And this is why we talk about leverage over and over and over on the Property Podcast. And it's not because we want you to risk it all. It's, use sensible leverage. If you're buying with a mortgage, it can supercharge your wealth. So let's look forward now. We've looked back 25 years, and those numbers are quite startling when you look at what leverage could do. But let's look forward. Let's start from today. Now, as we've touched on already, the last few years for shares has been very, very strong, particularly if you focus down to the US stock market, which has been one of the strongest in the world. And over the last 25 years, that market's actually done stronger than the world. And over the last 25 years, it's grown on average by 9.3%. So we looked at the world average before, but if you focus in on the US, it's even stronger. Last year alone, it grew by 22%. So if you go property versus the US stock market last year, even with leverage, it beats property. So why not just sell all your properties, buy Nvidia and Microsoft and be done with it? Well, Robert, I think it's safe to say that you can't expect 22% growth every year. And actually, the average of 9.3% over the last 25 years has largely been driven by huge growth over the last handful of years. And you can't bank on that being the same moving forward.
You can't. And the answer to the question, well, why not do that? Because it's done so well recently, is because it's done so well recently. And what I mean by that is, well, however good the asset is that you're buying, whatever quality it is, however lovely it is, the price that you're buying in at is really, really important. So if you buy something when it's expensive, then the lower your returns are likely to be in future. But what is something worth? How do you determine what the value of something actually is? And when it comes to stocks, the way that this is normally looked at, the way that you work out what is it worth, is relative to the earnings that it produces. And when you buy shares in a company at a high multiple of earnings, historically, this tends to mean that the future returns that you will make if you're buying in at that point will be lower.
And that's right, Rob. And the great thing is when we're looking at the stock market, the property market, there's loads and loads of data, and we can look at historical records. And when investors have bought into the S&P 500, that's the US stock market where all the tech stocks are, at today's valuation levels, if you have historically bought in at this valuation point, over the next 10 years, the returns have been near zero or even negative. And that's what we're dealing with right now. You're dealing with a stock market that, in terms of valuations, is at record highs. So those who bought early on and now are getting to these record highs, they're doing really, really well. Warren Buffett is selling down a lot of his stock right now and is storing lots and lots of cash. I'd say he's a pretty savvy investor. I'm not suggesting for a moment that you sell all your stocks and shares either, but what we are suggesting here on the podcast is that you are at historic highs. The recent boom is unlikely to continue. It's the same for property. When you're in a boom territory, a boom will last a while. It can last several years, but at some point it stops. And often after a boom, you have a bust. And that's why returns are so poor when you buy in at this type of valuation and then hold for 10 years. But then that begs the question, Rob, what about property? Isn't that overvalued?
Well, that is a really interesting question, because I think if you talk to your average person on the street, they'd say yes. You'd look at property prices and go, well, they're either at all-time highs or close to all-time highs, depending on which data you're using. Everyone's worried about affordability. I am sure the majority of people would say that property is overpriced. But is it? Well, I've attempted to put some data together for us. So if we're looking at price to earnings for stocks, the closest equivalent for that for property would be price to rent. So what is the property price relative to the amount of rent that it brings in? The problem with trying to do this is that we don't have reliable rental data that goes back very far. So the ONS only goes back to 2016, which is no use at all. The only data source that I could find that I have any trust in only starts in 2008. But let's work with that and let's go back to 2008 and look at how the price to rent ratio for property has changed. So in 2008, that year might ring a bell, this was at the very peak of the property boom. At that time, the price to rent ratio was 24. So that means you would have needed to collect the full rental income, no costs, for 24 years to get back the price that you paid. So it's 24 at the absolute peak of that boom. Let's go forward to 2012. By 2012, of course, the bubble had burst and prices had been falling for 4 years. Prices had fallen, rents had not fallen because they tend not to. So that means that the ratio had come down. The price to rent ratio was 20. So property, when you're measuring it in terms of the income it produces, was relatively cheaper, which kind of makes sense, right? It echoes what you were just saying. If you buy it in a boom, you're going to do worse than if you buy when prices have been falling for a little bit.
So that makes complete sense, Rob. But then let's ask the question, because we're jumping around with a time machine today. What's it look like today?
Well, before we get to quite today, I'll give you 2022, because that was another peak, right? That was when we'd had the post-COVID boom, when we had that little mini boom before mortgage rates started going up again. So 10 years on, at that point, the ratio had gone back up to 21.4. So still not as high as it was in 2008. But today, which is what you actually asked, if we take the average rent, according to the ONS, which is £1,329 per month, and the average UK house price, according to the Land Registry, which is £289,000, then we get a price to rent ratio of, drumroll, 17.6%. So remember, when it comes to price to rent, the lower it is, the cheaper property is relative to the rent. The peak of the last boom, it was 24. It came down to 20. It went back up a bit to 21.4. Today, it is 17.6. That means that if you're looking at this measure of valuation, this is only one way of looking at it, but if you are looking at property relative to the rent it brings in, it is, yes, obviously better value than at the peaks, but also better value than it was at the low point of 2012 and better than it has been at any point since we actually have this data. So I think, Rob, again, that is going to come as a surprise to a lot of people. I'm not saying it's easy for first-time buyers to buy. I'm not saying that property is a screaming bargain. I'm not saying anything like that. But I'm just saying purely if you're looking at price to rent, which is the equivalent of price to earnings, then property is actually better priced than it has been for many, many, many years.
I think this is a really interesting way to look at property affordability from a property investor's point of view, because you can look at it different ways. There's so many different ways, as you touched on, Rob, to assess this and judge this. But as property investors, these are the key numbers we're looking at, and these are the key things that are important to us. And it absolutely does suggest that there is reasonable value in the property market right now. We've had that silent property crash, and we've had a rental boom. So it's put property at a place where there seems to be a better value. And I think then it's reasonable to look at both the property market and the stock market and go, well, if one's booming and one's offering value right now, which one am I going to invest in? Now, I'm sure, without doubt, if you've got a YouTuber who is way into their stocks and was particularly into tech stocks, they'd be screaming at us right now with lots of counter arguments. But just take away the assets, just take away what they are in the background and just assess the numbers. Do you want to invest in something that's historically expensive or historically reasonable? Most people would take the asset that's valued more reasonably. It's all the noise, the hype, the media, the commentary that goes with all these asset classes, all of them, not just property and shares. You can extend this even further. That's where it becomes more confusing. That's where emotions come in. But when you look at it at data, and that's why we focus so much on the data today, it becomes a lot easier to make the right decisions for you.
That's right. And I think looking at the numbers is super instructive and you can learn a lot from doing it. But remember, we are talking about averages and we're making a lot of assumptions. What you really want to know is which is going to make the most money for you. And for most people, the answer is what will make the most money for you is property, regardless of all this other stuff. Almost put the numbers aside. Most people historically have done better with property because you can't mess it up, because the nature of property is it forces you to buy it and hold it and not mess around with it. I know so many people who panicked and sold their shares during COVID in that kind of flash crash we had for a couple of months in 2020. They sold at the bottom and didn't have the confidence to buy in again, either at all or until prices had gone up again. With property, you might have wanted to do that. I'm sure a lot of people did, but you couldn't because the market was basically closed. That was an extreme example, but you get what I'm saying. Most of the time, people do well with property over the long term because you just buy it and you hold it and you don't mess around with it. And that is why, for most people, the answer for what you'll do best with is property, just because you remove yourself as a factor that's likely to screw it up. But of course, Rob, it doesn't have to be that way. Ultimately, Rob, I think the best investment, put the numbers aside, it's the one that you actually make in the first place, that you're confident about, that you are interested enough in it to do your research in it, and then are going to stick with it for the long term and not panic. For many people, for most people listening to that today, that will be property because they've chosen to listen to this. Of course, it could be shares. We've been talking about the US market specifically because that's what's had all the headlines. But you could say, oh, well, the UK market is offering value right now. The Japanese market is offering value right now. We're not saying all stocks are overvalued right now. So you could take the same logic and come down on the side of investing in shares instead. But I do think, and this doesn't sound particularly scientific, but I think it's true, investing in what you want to invest in, what you're excited about investing in, for most people is going to be the answer.
And you know what? You don't have to do things exclusively. You don't have to be all property or all shares. Rob and I both also invest in shares. Clearly, the majority of our wealth is tied up in property, and that's our main focus. But we do a bit of that as well, and that's okay. You can do both, but do more of what suits you. Like Rob said, what are you going to be best at? What are you most passionate about? What do your skills lend you to? What do you feel more comfortable and knowledgeable about? I think a lot of people go for properties because it's easy actually to understand. Property as an investment, you buy it, you hold it, you collect your rent, and then in the future it'll be worth more. If you play around with it in the short term, that's when things can go wrong. But if you just stick with a decent property in a decent area and hold it for the long term and use leverage, you'll do very well. I think a lot of people shy away from stocks and shares because it makes them nervous. They don't understand it. That's fine. You can just use a tracker fund, which I think for the majority of people is the way to go forward. It's when people see the volatility moving up and down and the fact that you can sell very quickly is where a lot of people fall foul. And like you said, Rob, recently in COVID times when the stock market took a mini tumble, people panicked and then it went on a boom and people piled in the other way and then they got hurt when it started to ease off again. And now we're back in a boom. That volatility will terrify some people. And emotion in investment is your worst enemy. I see people making silly property decisions based on emotion, and I see people make silly stock investments based on emotion. So if you are emotional as an investor, and it's hard to admit that to yourself, it doesn't mean you're emotional every day, but if you get moved by headlines and you take action frequently, then maybe property investment's the way to go. Only you know. There is no best for all. It's what's best for you. And if you know yourself and you know your options, then I'm sure you'll make the right decisions.
Hub Extra, as we all know, a way to make better decisions around investments is to write down your thoughts and follow your thought process. That's a form of journaling. Journaling has so many benefits. Everyone's talking about it. I have never been able to stick with it, so I'm not qualified to talk about today's Hub Extra. I'm going to pass it over to you instead.
Well, I'm also not qualified, but producer Dan does journal. So the elite productivity people all journal. We're not at that level yet, but fortunately, producer Dan is. But also, fortunately, we don't let Dan on the microphone. So we are going to talk about it instead on his behalf. But he's been using Day One recently, an app that, looking at it, is pretty impressive. And if I was to start journaling, then this would be something I take serious consideration too. It's free to get started, which is great. If you're new to journaling and just want to give it a bit of a test, it might be worth checking out. So that's Day One. We'll link to it in the show notes. But I just want to give a shout out to the old pad and pen. I don't use it for journaling, but I found that I'm using it more for my to-do list, my actions, my thoughts, like capturing notes and ideas when I'm in meetings. I found that going back to the old school way of just pad and pen after years of using different types of tech has been really refreshing and actually super useful. So I've gone full circle here. Absolutely still use tech, still use Todoist, still use Monday.com. If you want a tech version of those things, they're great. But I just want to champion the old school, the pad and pen as well. I didn't think pad and pen would make it to Hub Extra, but here we are after several hundred podcasts, and turns out pad and pen has made it, Rob.
We've been through all this, and that's what we come back to. What has the last 12 years been for? But there might be a way of blending the two. I was in a meeting the other day, and someone was using one of those remarkable tablets. It's one of those where it looks like a Kindle in the kind of like the electronic ink. It looks like a normal notepad, and you write on it with a stylus thing. But then it like OCRs your writing, and it stores it all, and it's super cool. And I'm trying really hard not to go down a rabbit hole and persuade myself that I must have one of these things. But if anyone from Remarkable is listening and wants to send us a couple, we've never been bribed for a Hub Extra before in the last 12 years, but I'm open to it because they look really cool.
Yeah, 12 years of Hub Extra and nobody sent us freebies like mattresses, vacuum cleaners, like whatever. Like, I love a freebie. Like, I'm not proud. Send me free stuff. It's absolutely fine. We've got loads of listeners. I'll talk about your mattress.
We're putting it out there into the universe, especially the Remarkable Paper Pro 2, if anyone wants to send us a couple of those. But anyway.
I really like first class travel as well. So Qantas or Etihad, if you're listening, yeah, that first class travel, I'm happy to review. No problems with that.
Right, this is taking a turn. Let's stop this episode now. Thank you for joining us. Hope you've enjoyed this week's episode. We will be back to do it all again next week, unless the first class travel has come through for Rob, in which case I'll be doing it on my own. But until then, have a great week. We'll see you soon. Bye-bye.
Bye-bye.